Hey everybody, this is Danish from TYK Trade, and you are listening to Trader Talk, the show that gives you entertaining blend of professional insight and inspiring stories from professional traders for people who love technical trading. Today we would review NASDAQ and S&P 500 chart with Javed, who has over 2 decades of trading experience. Hi Javed.
Hi, Danish. How are you?
I'm good. Let me just pull up a chart and we can review the major indices. So in the grand scheme of things, the last year was a pullback, one full year of pullback
Yeah, that was the longest pullback since the financial crisis, I would say.
in 2018.
2008,
Oh
9.
yeah, 2008. I'm sorry.
Started, I guess, in late 2007 and ended in March 2009.
I have an interesting trend line coming in from that period, which I'm about to share with you.
Let's see. And that wasn't that much longer than, if you think about it, maybe a year and a half.
So I have two charts. Can you see my chart?
Yep.
Okay, I'm gonna switch to weekly chart on ES. I'm gonna hide these moving averages. And for the convenience to view it, in a broad stroke, I'll just switch it to a line chart.
Can you hide your Fibonacci?
Okay, sure.
Every trader has their preferences, and I prefer no Fibonacci.
Okay, let's talk about stupid straight lines,
Yes.
supposedly random lines.
Yes.
So I made the random line starting in 2011. It actually started in September, October 2011 here, and it's been tested so many times over the last 12 years.
Yep.
And it's more like a mean and reversal to mean thing. Market goes up, market stays down, market stays around this line. And look where we are right now. It's a weekly line chart.
Oh, nice. So we retested it.
So we tested once, twice, thrice.
Beautiful.
And on the top, this red line is coming in from last year.
Mm-hmm.
Every time we go up, this guy shoots us down.
Yes.
And if you
Agreed.
remember, I made these arrows.
Why is your red line not touching?
Oh, I'm going to show it to you. Why not?
Oh.
You see it now?
What'd you take off?
What?
What did you take off before?
Oh,
What
so
was the
I
other
made it on daily chart. And if I were to put it on a line chart on daily, every
Oh,
single
you drew the line on the daily. Okay.
I drew the line on the daily. Yeah.
Okay.
So every time it touches this line,
Oh, you put it on a line. That's why. No.
Yeah.
Oh, okay. Yeah, you can't see it on the line because you can't see the candles. Okay. I
yeah.
got it.
So if I were
So
to go
line
back
chart.
on candles and week, you will see the wicks touching
It
this line.
touches. Okay.
And
Yeah,
every
that
single
other one threw that one threw me off. Like, it's hard to draw this downtrend line with that huge wick. Could you highlight that wick?
This one?
No, recently.
Or this one? The current one?
Yeah. The red one. Yeah.
This one right
That
here,
one,
right?
it's hard to draw. That one threw all the downtrend lines off. Was that like a fake out?
Yeah. So if you were to go here on 12th of December on a daily, it was just 1 day spike, 13th of December.
What is it? 13th of December, right?
13th of
And
December,
around
market
that time,
rallied all the way from 4,050 to a high of 4180, 130-point rally. And then it just came crashing down.
was that a Fed day? What was that? Was that a Fed day? Why? What was weird about that? Was it Fed day?
This was a
Was it a
contract switch
CPI
day,
day?
and 2 day before this was a
NFP?
contract switch.
Is that an NFP day? I
I'll
don't
have
like
to check.
contract switch as a reason.
I'll have to
It was a
check.
Friday, right? It was a Friday.
Tuesday. It
Tuesday?
was a Tuesday. Yeah.
Maybe Tuesdays are CPI days.
So just one day and the market spiked up, came back down. Now, if you look at the current situation, we are hot again.
Yeah. We
I mean,
are really, when we break this line and we retest it from the bottom, I retest it from, how am I going to use my words here? Go above it and then come down and retest it underneath us. Yeah.
Yeah.
That is going to be very interesting, I'm going to say. Because I've been faked out so many times last year. So, but I don't get prematurely too excited, but that would be exciting.
So if I were to go on
Potentially
weekly
exciting.
again,
Yeah.
here is something I want to bring your attention to. So you may call this as a hammer or an inverted hammer here, a doji here, a hammer here, sorry, inverted hammer here, and a hammer here again.
And can I just jump in there while you're pointing those out?
Sure.
So all those retests of this downtrend line are a great lesson that I've broken so many times last year. But this lesson is as old as time in technicals, which is, don't trade that breakout until you get confirmation. And none of those times since the first time this line was created, could you go all the way back?
Yeah.
A line only needs, let's go back to the Algebra 101, right? A line requires 2 points.
2 points. So 28th of March.
So go back to the
3rd of
first
January to 28th of March.
There you go. That's all it required. That was like 3 months into this downturn. That's all it required. That's the beauty of this method. And then it continued the entire year we're heading into February now without breaking it.
Yep.
And, there's a lot that could have been done if you followed the basic rule, which is technical 101, of do not trade a breakout in a downtrend line or an uptrend line for that matter, a breakdown in an uptrend line until you have a confirmation. And so many of us broke that rule, but it's a good rule to.
I lost quite a bit because of that as well. I'll be honest.
We all will. I don't know a single soul who didn't and wouldn't even after decades of, trying to obey that. So it's something to think about and appreciate. The other thing is it was so clean if you really look at it, especially on the weekly, like when these, let's say, recessionary or economic downturn driven market downturns, even though it seems like chaos out there, can't decide if the Fed's going high enough, can't decide when inflation's going to be over, can't decide if we're going to have a recession or not. Okay, economic chaos. But the charts are pretty clean in the downtrend line. The downtrend line is there. We keep trying to retest it. When we can't retest it, we get lower lows until we don't.
Yep.
And then we get this double bottom, which is yet to be seen if we're going to hold. I don't really believe in triple bottoms. So if we go back down there to that double bottom, then I think we break through, because I don't think the market does triple bottoms on a supply, demand, and psychological basis. So go ahead.
But having said that,
go ahead. Yeah.
Having said that, the next couple of weeks are going to be turbulent.
Yeah, I think so, right? Because we're in a wedge, so we have to kind of, make or break here.
Yeah. Plus, we have Fed and earnings coming up. Next couple of weeks is earnings, and then 31st of January is Fed.
I want to say something about both. So I would say in the past, these things would be baked in largely way before. But it feels to me like that things don't get baked in as early. And one of the explanations I read, and everybody's got their theories of why things don't get discounted so early as they used to, is because the Fed is data dependent themselves. So it's a little bit circular. Like the Fed is waiting for data, so the market is waiting for the Fed. So the market reacts a lot closer to the data now because the Fed is so data dependent, supposedly. Right?
Yep.
So there's that explanation. But I would say on both those counts, the Fed has always been largely baked in. I haven't seen the Fed futures move very much in, let's say, the last 6 months. So I don't feel like the Fed has been that surprising. Now, earnings, I think we've had, I'll tell you what I feel about earnings. I think that even though we don't have an official recession, or even if we get recessionary data in the GDP, Biden refuses to acknowledge it or tries to change the definition of recession, which is very interesting. So everybody refuses to acknowledge a recession, but companies are acting like they're in a recession, which I think is great. You kind of get to, you have Goldilocks in that environment, which is companies cut like crazy, but we're not in an official recession. So they kind of like preempt it and don't have a fire drill or emergency in a recessionary environment, because they're trying to acknowledge a slowdown regardless of the official economic terms. I think that gone are the days where companies wait for an official recessionary announcement to cut their people. And we can have all kinds of theories on that, where they need some cover, right? Managers need cover, especially if, like with this Google cut, everybody's like, oh, you're going to take full responsibility, CEO? Well, then where's your pay cut? There is none for him. So what does that mean? That's BS. If you're going to take full responsibility, take it on the chin. Eat it with us, right? Yep. And he's not. So it's just words. It's total BS. So, he was waiting for cover. It's that management BS game where they need cover to do it, right? Because a lot of these guys are top performers. Like, usually top performers get cut first because the manager gets a number, and the number gets hit a lot easier if you cut a person with higher pay, right? And that guy's going to want even more pay when it's a tough cost environment. So you're nipping the problem in the bud, right? So these guys all want economic cover. Oh, you're a great performer. Well, I cut you because it's a recession. We need to cut costs. I mean, we need to cut the guys who perform the best, actually, because we can't afford them anymore. So they need cover, right? So he waited for cover. And companies are not necessarily waiting for the official cover, because they get cover in other areas, like inflationary environment. Mm-hmm. And I think the cover that nobody is really using yet is that I think will be used for decades, honestly, is the baby boomer demographic time bomb that we're facing. So demand destruction is what I mean. Mm-hmm. So I think companies, and we already kind of see it in certain industries, but companies will finally, I think, acknowledge that we have permanent demand destruction. We had like half a century of demand gains after World War II, right? And the baby boomers started coming into their higher earning potential as the largest demographic population in the history of the world, right? Yep. And so we enjoyed decades of that. And then global trade juiced it, right? So all baby boomers combined could create more global economic output, right? Okay, fine. But now we get the hangover, right? Because they're all in that age where they retire. Let's say that's the nice way of saying it. Mm-hmm. Or they choose to retire, or they're dead, right? So they disappear regardless from the workforce. And that hurts. And they disappear from consuming power, right? Which is even more important probably than existing in the workforce, given the uses of automation to replace the work that they did, right? But they don't demand anymore, right? And automation doesn't have as much of a demand by definition, almost, right? By the reason for being of automation, you don't want the demand. You don't want somebody who eats and drinks and sleeps. So it's very interesting, right? As we move to automate this work that wasn't done, that automation that creates that work is not going to go demand consumer stuff in the economy. Yep. And 2/3 of this economy in America is consumption, So I think companies, even tech is going to say, look, demand's just not out there and it's not coming back. So they're going to use that to continue cutting, which is actually should be good for the market to find a base. Now, I'm not saying we're necessarily going to get growth, the kind of trajectory of growth we got before, because you need demand for that, I would think. Because there's a limit to cutting, right? To grow your earnings per share. There's a limit to buying your shares back. There's a limit to cutting. Demand is the ultimate thing that grows your earnings and top line, on a permanent basis, right? That keeps the trajectory going. So I think that we'll find a base that comes from cuts and being more efficient in your EPS. That's fine. The top line, the ceiling comes from how are we going to solve this demand growth problem? And I think one of the ways the Labor Secretary of America spoke to, he said we're coming up to like some kind of cliff here with finding labor. And I think there was a New York article yesterday. They just can't find workers in New York City, right? And so I think until governments go the opposite direction of the way they've been going, let's say with Brexit and Trump and immigration and all this up in arms about migrants and refugees, I think when we flip the coin on that and finally open up movement of people and labor, like we did with NAFTA, like Europe tried to do with the European Union, and open up trade with other countries, not just doing trade primarily with the most favored nation status with one country, like China, which we're not really friends with as much as we used to be, given what's going on with Russia and in the South China Sea, right? So we need to open up trade and open up immigration. Until then, it's going to be really tough to get a demographic replacement for losing all the baby boomers from consumption and the workforce. So I think that the ceiling is yet to be seen because there's limits to productivity. We're already seeing that, and growth. And you can only cut so much to get higher on our EPS, or you can only buy so many shares given a higher rate environment that we live in now.
Yep.
And traditional sectors that kind of represented growth, like real estate, that's gonna be really tough. Like I read an article a long time ago that I like to quote a lot of times. Before we had this demographic boom from World War II, post World War II, we had so many houses in America, and I haven't verified this, so it could just be something sensational, but it kind of makes sense to me that FDR decided they were going to burn houses down. The houses that are
I know.
Yeah, I haven't verified it. I should look it up, but it kind of makes sense. Like that's a desperate move because you have too much supply. And I think it's going to be very interesting, this kind of migration happening in America right now, of moving to smaller cities or moving even to areas that are just complete frontier, like North Dakota, Montana, Wyoming. They did this in the pandemic, and as remote becomes more permanent, remote work, this will happen more. This is helpful in real estate in that you'll have pockets of real estate that'll still keep growing because they won't have enough housing in those areas people are moving to. But then the places they're moving out of, like New Jersey, New York, California, these traditional Northeast states, West Coast states, when they move out of them, we're going to have an oversupply of housing if nobody moves back in, right? Because a lot of industries are leaving these high cost areas, high tax areas.
Raleigh is
Immigrants
already.
traditionally.
I know a friend of mine in Raleigh Raleigh. I used to go to Raleigh for my work back in the day, and it used to be pretty nice and calm town. I would say a town, not even a city. And I'm not even talking too long back. I'm talking about like 10 years ago. And now Raleigh is becoming like as big as Atlanta.
There you go.
So
and so they're building houses there, and then what are we going to do with all the empty houses out here if everybody gets moved down to Raleigh, right? So it's going to be, but I think one of the saving graces will be also that a lot of us who want to stay up here can still work remote, so we can kind of work for a Raleigh company but work from here, as they find a shortage of workers, right? And they come back around to saying yeah, I'll still hire you if you're from the Northeast because you're highly qualified and we need people. Right? So I think there's a case to be made of not unlimited growth like we had before. I would expect range bound markets like we had in the 50s and 60s until the baby boomers, even 70s, first half of the 70s, until the baby boomers came into, it follows the demographics, right? We had World War II, the baby boomers were born, but they weren't earning yet. So those were dead decades, right? 50s, 60s, early 70s. And then Nixon screwed it up with all the inflation, which Biden is doing now. So we got that early 70s. And then, then 80s, like Reagan came in, deregulation, one of the best things you could do to create growth. And we got off the gold standard, right, with Nixon. So we opened up fiat money, right? So that helped liquidity. And Nixon opened up China, right? And we started global trade, right? More global trade. So, and Japan, right? And then Europe, right? And then we had the Apollo Accords. No, what do you call it? Plaza Accords, Plaza Accords, fixed our currency mess up and moved forward. And then we had the dot-com boom, and then the rest is history, right?
Yep.
So where are we going to get these next big, big shifts in the world, right? Are we going to get leadership? If not, then we could be in for years of just kind of stagnation, which is not bad as long as there's a floor there. But if we do get that stagnation, it's going to be very interesting what works in that environment to keep getting growth, right? And I think one of the best things that works in a range-bound market where you can't just expect more growth just because you're buying and holding, if you're not putting unlimited cash into your portfolios, is yield, And yield is hurting in real estate, as I said, unless you're getting those pockets of growth in other cities that continue to have migration of people into them. But I think yield in the market will work well. Either the traditional yield, like just collect the dividend, or a synthetic yield where you create a dividend from options, selling options. And I think that will continue to help growth. I think it was very challenging in the last year to do that and still find your portfolio growing, because no matter how much yield you sold, it wasn't enough to counteract how much you're going to lose in the underlying, and that kills your net liquidation. Fine. And then we get these huge jumps that kind of kill your share count too, because you're buying at higher prices, right? So fine. And you're blocking it by selling calls close to your overhead, right? Over your head.
You're blocking the upside.
You're blocking the upside. You're buying shares higher when you're chasing it. So that is all kind of hurting you. However, when you have a stable basis, you're showing 1, 2, 3, 4 retests on, then you kind of then as you're selling yield, you're developing some growth, which is nice, So if you can, and this is why it's so important to, as Yasser used to tell me, it's like he heard this from a famous trader. It's like it's more important what's going on outside the market in your life than what's going on inside the market. And inside the market won't work unless your outside the market life is figured out. What I mean by that is you need to have your expenses and income outside of the market taking care of your day-to-day life in a way that you can figure out what to do when the market's not working for you. Like last year, market was probably working for no one, even the shorts, because they got taken out by these massive rallies. If you have a huge short on, the rally's built to give you a margin call so that the broker will force your closeout. That's why the rallies are so powerful, right? So a lot of those rallies, the last legs of those rallies are not the traders, not the portfolio owners. It's the brokers closing you out structurally. Because your margin call is too big, right? So everybody got hurt.
This wick here.
Yeah.
This wick here.
That's the brokers closing you out. That's just a structural thing. That's closeouts. They don't have to get your permission. When you sign your broker agreement, it says we can close you out at any time if you have a margin, right? If you don't have margin, they cannot do that. That's your cash is protecting you. Your position is protected. But if you do have margin, Even like $1 margin, they have the right to close you out at the lowest price, at any price.
At the worst price.
At the worst price.
What is the whatever is worse for you? They can actually
They can do it.
and they
They
will.
legally can, contractually can. Contractually, they can. You made that contractual agreement with them, and they will do it every time.
They can and they
will
will.
They will protect their balance sheet way before they protect yours.
Yeah.
And that because they're a business, they're a for-profit business. They're not in the business of losing money as a donation to you, so you can hold your position indefinitely. So all those are important things to know. So I'm very positive about finding a base. I have no idea if we'll get back to the highs. However, that is why I focus on yield most of the time, because I want statistically, most of my life, and I'm 47 in March, the market has been flat to up. Most of my life, if not all of my life. And in the grand scheme of that 47 years, I'd say almost half a century, I'd say. I could round up now. For better or for worse. For better in that I have experience, for worse in that, okay, life is short and, fragile, right? So, in half a century, the downturns have been very short and I expect them to continue to be short. Downturn in meaning lower lows continuously for a continuous time period, which we had last year. So if we can find a range bound market with some kind of flat to slightly rising base, that would be tremendous for wealth generation if you're selling yield, in my statistical structural opinion of making money off of the market with not too much effort. And I've even written programs that would just sell yield without even your involvement in it. You just have to have the machine on. That's it. And there's ways to even give it put it on a headless environment, and then you don't even have to have the machine on. Just put it in the cloud. So go ahead. I'll let you talk. I spoke a lot.
Look at this chart. You're talking about in a grand scheme of things. I just turned it into a monthly chart.
Yeah, there you go. Right.
This
so
is
very
giant head and shoulder, inverse head and shoulders in the making.
There you go. All right. Yeah. And that's how a bottoming process after a long downturn usually is, right? You need to see that rounded bottom, inverse head and shoulders. You need to see double bottoms. You need to the bottoming process is never really just a down and then up after a long downturn. It usually requires a little bit of retest, right?
And
so
that's
you get
fine.
a couple of chances. Yeah. Go ahead.
Retest, and that is fine because retest does confirm that we are not going down.
Yeah, and that you need that confirmation on both sides. So what happens is the buyers get more confidence. That's the obvious one. But the more important one probably, and in my opinion, and people can refute this, it's not the buyers that bring us up, because the buyers, the biggest buyers out there are always buying anyway, consistently. So it's not like they give us extra fuel, nitro, to just juice us. They're always in the market. Vanguard's always in the market. Fidelity's always in the market. Your pension's always in the market.
Warren Buffett is always in the market.
If you're working, you're giving them cash every 2 weeks, even if you don't realize it, to put in the market, good or bad. Dollar cost average. It's been around since the 50s. Won a Nobel Prize, right? So, okay. But the guys who really get us the momentum to break out of these, downtrend lines, I think are the shorts. So when we retest, the shorts are getting frustrated because shorts make money when you go down more, when you get lower lows, when you find that you're breaking whatever support you had. When the shorts can't do that, they get less and less opportunity to put on a short because the risk reward just isn't there for them. So when all these shorts start really covering, or we break these downtrend lines and the brokers cover for them, then I think we get some serious momentum, back up to the necklines. That blue line you have there, how'd you draw that? That blue line is very interesting. I think that's the ultimate neckline that we need.
I'm gonna show you.
Right.
I'm gonna show you.
That's the neckline that matters.
You will appreciate it.
On the head and shoulder.
So you mean this light blue line?
Yeah. How'd you get that?
This is supposedly oh
Is that the pandemic?
no, that's a doji on a month. Oh, on a quarter. That's a
21.
doji on a quarter.
Why'd you
So
draw it there? That blue line.
it's why did I draw it here?
Why'd you draw the blue line there where it is?
Okay, so in the quarter of July 2021, third quarter of 2021,
Mm-hmm.
market moved only 18 points
Okay.
in 3 months. Now that's a zone of consolidation. It's a
Okay.
ceiling.
Fine.
Now consolidation is support and resistance in itself, right?
Mm-hmm.
You
Mm-hmm.
cannot just go through the consolidation zone just like that. So it's a
Okay.
quarterly doji that I had pinned here. And if I go on a weekly or a daily chart, you just cannot miss this line.
Great. That looks like the neckline to me. See, that was the last high retest. I think this retest will be easy. The one coming up, breaking through this high over here, this lower high. This
This one
one
right
and then the
here,
one before. Yeah, that one. That one should be easy. But the ultimate, I think, will be that blue line.
this guy.
Yeah, and I think that'll be the head and shoulders retest. That'll be the neckline of the
Yes,
head and
yes,
shoulders.
it is indeed.
Yeah. And then if we break it, we need a measured move from the bottom of this head and shoulders to that neckline.
4,300 to the bottom being at 3,500. So 800 points.
Yeah. And I think that'll be a good solid 800.
Yeah. And if I
And
go to NASDAQ,
then
I wanted to
the
show you
economy.
NASDAQ chart. Not this one, sorry. Let me get rid of these lines. Do you remember this smile curve that we made?
Yes. So since you brought it up before, we retested it again, probably, right?
We have tested it once, twice, and we are still in that consolidation band.
Yep.
So I won't be surprised if it hits here and comes back to test the smile curve
Interesting.
a couple of times and then starts going upwards from there.
Okay.
You and I were actually joking about a U recovery this time,
Yep.
and that's where we are. Slow and steady, just tagging along this line. And this week, if
Yeah.
I were to show you day, you will see test that line.
Yeah, the interesting dilemma for the Fed that would keep us in a range bound market, which some economists talk about, is that if we grow too fast, then that'll bring inflation back. Then the Fed has to get more aggressive
Exactly.
again.
That's why they have to keep it nice and slow.
Yeah. That's why they'll over tight because that guarantees that we don't get hyped up. The animal spirits don't come back because the animal spirits are what creates inflation. The other entrenched issue they face, often wage growth is cited as the leading indicator of inflation, right? Because wage growth just cycles through and then feeds everything else, right? You make more money, you buy more house, you buy more stuff. Fine. And stuff buying is 2/3 to 70% of the GDP in America. So The problem they face, which is a structural issue, is the whole baby boomer problem. So because the baby boomers are gone, quote unquote, everybody who makes money in a professional job makes more because there's a limited supply of those professionals, you know. But what is tremendously helping is the headline job cuts, which should scare workers from asking for more money and jumping as much as they did, and give managers and senior execs tremendous cover to just be like, we're not giving you a raise, we're not giving you a bonus, and you should be happy to have your job. I think there was an article about junior bankers, finally, because we had this ridiculousness going on in Wall Street, where they're saying junior bankers barely got a bonus this year at a couple of top tier Wall Street firms, which is great. But it's pretty interesting that it happens so quickly after you hear ridiculous signing bonuses and starting pay for undergrads coming onto Wall Street just a year ago. And now already they're like, first of all, getting caught, and second, not getting any meaningful bonuses, which is it's Wall Street is just whiplash like that, right? One year it's like heyday till the sun, you know, till kingdom come. And then the other, it's like, oh, it's the end of the world. We don't have any deals going on. We don't know when we're going to have any deals. And people are getting cut and you're not getting paid.
Yep. Yeah.
Which is one of the reasons I moved on to data, you know, and IT, because I feel it's a lot more consistent. Regardless of what big tech is doing, it still feels a lot more consistent.
Yeah, I hear you.
In demand.
Yeah,
it's not like great times this year and then you don't get anything and go get another job.
Consistency is what matters more.
Yeah, exactly. To me, it does personally at this point in my life. You know.
I hear you. All right. Cool.
I think we covered a lot.
Yeah.
How long
we
was
did.
it?
It's been almost an hour.
Wow. Yeah, we know how to fill an hour pretty quick.
Almost 50 minutes now.
Yeah.
So bottom line is we have seen the bottom, but we are not going up flying high, just like that.
Yeah, I don't really see the justification for it. If we do, we'd have to come down because we need some secular trends to take place, either technology, right? And that's been a long time coming in terms of like having a big technological shift, right? We have this wireless and everybody's mobile and connecting with remote supplies of workers and stuff. But, you know, is Chat GPT and AI going to set us off? I don't know. I don't know if it's as much of a marginal change from what we've seen so far and harnessing that, you know. So Google's a leader in AI. They're cutting, you know, so they have a threat from some other places, like what's going on with Chat GPT. But I don't know if we have any big technological takeoffs on the horizon. If we don't, then I think it's always going to be people still, even in 2023. And it's like, how do you harness the power of people and their consuming power and their working power in a more effective way to try to get that next leg of growth for the next couple of decades, you know? And I don't see global leadership moving us in that direction. So until they do, I just don't necessarily see a decade of, oh yeah, let's see another 90s. Let's see another 2000s until the financial crisis. I think we're still in the hangovers from the financial crisis, which kind of was discounting this baby boomer sunsetting. I think we've been discounting the baby boomer time bomb, I'll call it, for 15 years now.
Yeah.
And I think we're finally starting to acknowledge. I think the pandemic was a catalyst on that because a lot of them just left. I mean, pandemic was pretty discriminatory in that it affected older people much more than it affected younger people. So a lot of older workers decided, I'm not going out there anymore. Period. You know. So I think that until we solve, quote unquote, that problem, I think market will reflect that issue more and more. And that'll be in the form of limited growth, which is what we had pre-World War II maybe caused it in a lot of ways with, what happened after World War I. We never got a demographic boom necessarily, just got a big consumption boom and then hangover from it. And then we had that hangover from World War II until the baby boomers got into their earning years. And I think now we have kind of the hangover from that demographic shift that wasn't solved. The other statistic, which is interesting, China finally reported population decline for the first time, I think. Yeah. And I think that's going to be every year for the rest of, our lives. Is these?
Well, I was reading that the world will stabilize at 11 billion, 10 to 11 billion.
Okay.
And then
go down permanently.
Yeah, right? that's where we cannot cross the threshold.
Yeah. There you go. Well,
because of the equilibrium happening, right? The negative growth trend happening in the Western countries.
Yeah.
And even China for that matter.
Or let's just say developed, right? So
yeah, developed
countries become more developed and
the fertility rate goes down.
Yeah, fertility rate goes down. Exactly.
Yeah. So only Africa by the year 2100, Africa will have 40% of human population. Close to 40%.
Growth or
no, population? The human population, 40% of the world will be in Africa, which is 18% right now.
And that's fascinating because as a banker, that's like the unbanked continent. Like except for MENA region, like North Africa,
Middle East and North America.
Even North Africa is, in turmoil now. So say largely Middle East, basically, because North Africa is kind of nowhere to be found in a lot of areas because of all the turmoil there. So just Middle East and the rest of Africa, kind of from an economic standpoint, almost doesn't exist for most of the world. Trade,
unexplored territory,
bank, unexplored territory, and they're gonna have 40% of the population.
That's right. So that's going to be the next big thing, just like India and China right now.
Yeah.
80 years from now, Africa will be that place.
Right? And it's fascinating to see what happens with these places that they try to reach liftoff of being developed versus being undeveloped, because you get a pandemic and it feels like they go back like 10, 15 years. It's crazy what a pandemic can do to your structural growth, your economy and whatnot. You see Pakistan versus Bangladesh and what's going on there. Where was Pakistan 30 years ago? Where is it now? I think they're almost facing a potential famine, right? So
and potential bankruptcy.
And bankruptcy a couple of times.
Yeah.
And whereas
Bangladesh has been doing pretty well.
Yeah, exactly.
I mean, the per capita income is actually about to surpass India's.
Yeah. It's ridiculous, right? Because they were barely on the map 30 years ago, 40 years
that's
ago.
Right. They did not even
winners
exist.
And losers. They didn't even exist in the map. You couldn't even ask anyone in America what's Bangladesh. They don't even know it's a country. Right?
Yeah.
Okay.
All right.
Covered a lot.
Thank you very much, Javed. And let's catch up more often. And we'll go over the charts next time we meet again.
Cool. Let's see if they play out the way we're hoping they will.
All right. Thank you. Bye-bye.